Okay, so today we're going to talk about annuities. It's actually a really good time to talk about annuities. We've seen tremendous growth in offerings, in people purchasing annuities, even with Valor. We've increased our annuity business from 23 to 24 by like 2,000%. And then 24 to 25, we increased it again by another 25%. So people are talking about annuities. People are wondering what they are. And so, the focus for today is to see what people are so concerned about. When you think about reasons for retirement products, you have several reasons why someone would want to do a retirement type portfolio. First and foremost, you have fluctuating investments. So, how can we curb some investment fluctuation in regards to, seeing what happens in the market? So, we want to protect ourselves from, fluctuation. Also, lower returns. So when people are getting low returns, they tend to get a little choppy. I'll put it that way. So when we think about some things that we can do from guaranteed retirement side to help protect against the market volatility, help give them some type of retirement, we can utilize these opportunities here. And then also unexpected costs. If we can mitigate unexpected costs like healthcare rising? What can we do to help these individuals in their retirement protect themselves? And I think that's something that we should always, kind of be aware of in regards to looking at retirement. So when we think about this, we want to understand like volatility. You know, is our customer what you would say overexposed? And a lot of people don't realize that these percentages of loss, it takes 11.2 to recoup from a negative 10% loss. So if you have a major stock market crash and you lost 50%, it would take a 100% gain to just come back to a net neutral. So, how can we help customers continue to grow the pie, protect what they've gained, and not lose it? That's when we talk about the benefit of annuities. So, once again, when we look at these type of products, you always worry about the eventual loss, but with us, we don't have a loss in our products as long as you're not using the fee-based products. And you'll see here, on this side, if someone had something that had, kind of taxes and consumer price index or inflation, even a 6.58% return is not really that much after you look at inflation, or 1.81 is negative. So a lot of people don't realize the hidden concern of inflation. So when we look today at the agenda, we'll look at the two sides of annuities. There's an investment protection side, or excuse me, an accumulation side, and then we also have a income product side. So there's two different types of annuities. When you look at how you can grow your money, there's different ways that you could do it. So there is the fixed way. I'm going to use this little guy here. So there's the fixed way, which is very slow and steady, as you can see here. You have the variable way. Everyone loves the ups, but hates the downs. Okay. And then we have the index way, which you'll see right here, where when it goes down, you're protected against market loss, or you're capped in this scenario, uh, and you hit the peak there. But when this goes down, you're still here, so you don't lose any money. The market goes up, you kind of peak with it, then it goes down and you stay level. So once again, the benefit of indexing, as you can see here, gives you a benefit that you can't get from, a traditional policy like a variable. So here's the idea with the power of indexing. Uh, Often looking at our product suite, let's say, for example's sake, someone invests $100,000 and then the market goes up. And if they were in the raw market, they'd make $126,000 or 26,000 in profit. Whereas they put it into an index annuity and it's 113. But now, if I was the investor and someone gave me the two options, I take the this option, I'm happy because, I made double what I would make with an annuity. But the problem is that, let's say for example's sake, I go this road and I take the 113. Well, my friend over here is making 126, and then the next year I got 124, and my friend has 151, so I'm getting pretty mad. Well, the market goes down, and my friend just lost roughly, 14, $15,000, but I stayed the same. Still not happy because that person has made more than me. Well, market takes a big tank, and he's at $90,000, and I am still at the 124. So I've actually protected against loss. And if we go back to that screen before, when we talk about how much it takes to recoup or get you back to neutral, it takes a while. So as you can see, now the market goes up and I'm up. And as you can see, the trail, there's differences. So when there's down years, you don't participate in the down years, you only participate in the up years. Now, I will say this, just because I'm always honest with everybody, the market should be able to recapture at some point. Like you see up here, they're close to even, and then there was another downturn. Well, more than likely, this can supersede past the index, and it probably will. But when you talk about a well-balanced portfolio, you'll see that the fixed index annuities are kind of in the middle. I would actually personally say that they're over bonds when it comes to a rate of return. I consider them an aggressive conservative. So when you talk about any type of diversified plan, most people have mutual funds, stocks, which can be rather risky. You can also include real estate up here. And then to balance out the portfolio, you could utilize fixed index annuities because it can integrate in with the S&P 500. So it can be a bit more aggressive than a fixed, a CD, money markets, cash, but it will be more aggressive to give you a higher return long term compared to just putting it in stocks, mutual funds, and bonds. Any questions so far? All right. So there's two different types of annuities, and we're going to take this off of the screen in a minute to show you what I'm talking about from an example standpoint, with some illustrations and some designs. So accumulation annuities, where would you use an accumulation annuity? So you'll see the focus first and foremost is on growth. Okay. All we care about is how this policy is going to participate in the market. So the benefit of these products, they have higher participation rates, higher cap rates, and they also have the downside protection, so zero is the hero. Some of these have premium bonuses, we'll talk about that, and name brand investment companies. So when we look at name brands, we look at the Nasdaq, which is, very popular. We look at the S&P 500. UBS is a, international hedge fund management company. BNP Paribas, it's also international. So you have some name brand recognition. You have some carriers that will provide a bonus. Okay, so this is providing a bonus. So if I put 100,000 in on this base product, then I would have $112,000 in the account. Now, for those thinking, I'll just surrender it day one, net profit $12,000. There's a thing called surrender charges. So, no, you will not net profit, you will lose. But in this example, you'll see it kind of flip flops here. You'll see like this side has a bonus charge. So if you want a higher bonus, you would pay an asset fee or an annual rider charge of basically 1% of your cash value. So is it worth it? In my opinion, the answer is no. You'll find that most people will lose more than they gain with these riders. And you'll see here too, there's a participation at 200% or 145, and the difference is a charge of one and a quarter or no charge at all. Excuse me, I'm got a frog in the throat. So the idea of participation, in case you're like, what the heck does that mean? Participation, we look at a data point. So today is February 5th, 2026. So that's your first data point. February 5th of 2027 is your second data point. So that is a point to point strategy. And whatever this AI powered global opportunity does between the first year and the second year, they will credit me 200% of the return. That sounds all fine and dandy, but the problem with that is most of these are extremely conservative. You will not see a 20-30% return. I like working with things that have lower return, like 95%, 89, 70%. Why? Because they actually they're a higher volatility fund. So in order to balance the higher volatility or higher growth potential, they have to reduce the participation rate to a lower rate. Okay. Or you could do a cap strategy. So if the market between that point to point does 20%, in this scenario, you get 7% credit. If it does 5%, you get 5%. If it does zero or negative, you get a zero. So you have that downside protection. But if you chose to do it with the fee, if you had a negative, you still get a zero for credit, but your cash value is getting charged 1.25%. So again, not a fan of the strategies that have charges built in. I don't think it's advantageous for the customer long term. Customers for this type of annuity are usually probably 40s, 50s time frame. They have probably had a job that they are no longer at. And what happens is they had a 401k, a retirement plan set up at their prior job. And now, because they're separated from service, you can actually move that 401k to an annuity. And the benefit of doing that, again, downside protection, upside opportunity, and they don't have to think about it. And if you stick to the no strategy charge, there's no fees. 401ks have a 1 to 3% fee charge per year. So if you stop funding in a 401k, now all of a sudden there's a lot of fees and not a lot of juice added to it. So it can hurt your portfolio. On the flip side, we have income annuities. So in the last side here, accumulation, we have premium put in and the growth of the product. That's the only two levers. So premium put in and your cash value based on your return. In the income annuities, the idea is to maximize your guaranteed income. Okay. Now, how do you maximize guaranteed income? This client puts in $100,000. And this company at this time, this is an old deck, would ratchet up 10% every year, guaranteed. Now, there's three components to the income annuities. Premium put in. There's also the accumulation of the product, but there's also what you call a benefit base. And they all operate differently. Okay. So the idea of the benefit base, this is that 10% going into the benefit base. It's not going into the cash value. So you put premium in, your cash value can fluctuate, it'll grow, but then you also have this guaranteed ratchet of a benefit base. And the easiest way I can explain it is, back in the day at Disney, if you walked into Disney, you could exchange $1 for a Mickey buck. So it's like it's the same currency. You just have fun because you're spending a Mickey buck instead of $1. But in that case, you can't take that Mickey buck and go spend it outside at Universal or somewhere else. Okay? It's only good at Disney. So the income benefit base that you're growing inside this annuity is only good at that carrier. You can't roll that benefit base over to a different product. So you could have an initial fund of 100,000 that you put into it. The cash value might be at 125,000, but the benefit base might be at 250,000. So what happens is you would get your guaranteed income off of that benefit base, not your cash value. So you'll see in this example, this 10% is credited every year up until the client takes out the money at 75, and they're giving an 8% withdrawal factor on $350,000 benefit base, not cash value, but benefit base. So it is different compared to the other one, but this is more for people who are getting closer to retirement. 50 and up is usually where you would see this type of conversation because people are starting to plan for their retirement. If you're familiar with a thing like a pension is what companies used to give their employees as guaranteed income for their retirement. You're creating your own personal pension with this. It is guaranteed for your life. You can actually guarantee it for a joint life. So you and your spouse. It does have the downside protection and premium bonuses too. And some of them even have long-term care riders. So there's some interesting things that you can do with these type of products. So benefits. Benefits to the customer, protection of principal. You can grow without loss, income that's guaranteed if you're doing the income product, and relief of knowing that, the client knows what their retirement's going to look like, at least from this side, with predictable outcomes. So for the producer, you have an asset class that can help the customer retire more comfortably. It's a turnkey product that can be replicated and instant compensation with no underwriting involved. So the other thing is, it's a lot easier to have a conversation with people because most people want to focus on the retirement, not so much death, right? So that's where you can win with annuities. Now, if we look for example's sake, I'm going to pull up a software that I use. So, first and foremost, if you ever want a quote request for annuities, life, whatever, there's quotes.valorfs.com and you'll see annuity quoting form. So, if you think you have a client, agent name, email address, client name, residence, so what state, age, gender, initial investments, so are they putting 100,000 in? Any additional investments, so are they putting in more next year, the year after, or is it one time? What type of account? Qualified is your 401ks, IRAs, anything pre-tax. Non-qualified would be cash from their account. Okay, so it's already been taxed. What are they looking for? Accumulation or income? Okay. And if it's accumulation, how many years do they want for a surrender schedule? 5, 7, 10. Traditional accounts, like what do they want for index strategies like the S&P only, or you could say anything. Single life, joint life, or if they want income, yeah, single life or joint life for income. When do they want to take income? At what age? If joint, need the name and age of the spouse and hit submit, and it'll come to my email. Then what I would do is I would use this software. So I would create a case, or I would try and do it as easy as possible. I think it is, let's see, they upgraded this recently, so it gets kind of annoying. Let's see, create case. Nope. Here we go, new client. All right, let's just say Phil Resch, Tennessee, and we'll say I'm 45, male, and we'll say I want an investment of $200,000. Okay. And it's from an old 401k. So now I'm going to put it into a traditional IRA. I'll hit create client. Now, if I go to the navigator, let's say because I'm 45, I want to do income or accumulation, excuse me. So I click on accumulation. I want the fixed index annuity, not the MIGA. MIGA stands for multi-year guaranteed annuity. It's like a CD from a bank, just from an insurance company. So the fixed index annuities are over here. 200,000 is my investment. I'm going to move the money one time because it's from an old 401k. And then I don't want any fees. Okay. It's recommended, no fees. And I have no plan to touch the funds because I'm too young. And I want to leave it there for 10 years. Next step, I want only the S&P, NASDAQ, or Russell 2000. I don't want these proprietary indexes. And then A rated or better. Now what it'll do is it'll shop for me and it'll give me some options. So right here, this company security benefit has an 80% participation rate with a 3% spread. What does that mean? So if there's a 10% return, the first 3% go to the company and then you get whatever's left. So 80% of 10% return, so that's 8% minus 3, that's a 5% return. But we've seen the S&P do some wild changes, like 20% returns, 15. So you'll see here, you have 10 years, average 11, 15, 9.6, 20 years, 8.86. So if I wanted to look at this illustration, okay, this is showing the quote that I just wanted to see, the 1 year S&P point to point with 80% participation, 3% spread. And this is the guaranteed values. So in this scenario, you have nothing that will happen pretty much, but you'll see here it's a 10-year product. And even with absolutely no returns, so 0%, I would still walk away with $21,000 or 20, yeah, $21,000 in profit. So it's cool to say, guaranteed floor, so to speak. But let's look at back tested with some returns from the prior years. So this includes the spread. This includes everything, the 80%. So you'll see the credit interest rate. So 5.23, 13. Nothing. 20, 10, 19, nothing. So what they do is they back test these and they, like you'll see again, 5.23, 5.23. So every 10 years, what they're doing is copy and pasting and showing how this has a hypothetical opportunity. So as you can see, your ending contract value after 10 years should be 570. Now, I'm here to tell you right now that won't be the case. I would say your 200 will probably double after 10 years. Okay. These illustrations are pretty, but you have to temper expectations. So 200,000 will get you 570, or let's say 400, 450. Still a great return with no loss, no fees, and it continues to grow if you want to leave it there. Okay. So again, all you're looking at is the premium put in and the contract value are really the only two things that most people look at when it comes to returns for an accumulation annuity. Make sense? Questions? No questions. Okay. All right, let's flip the script here. And now I want to be a 50-year-old and I want to do income. So I'm going to restart and I'm going to do income, lifetime income, 200,000, one time, single, ready to mingle. And let's say I want my retirement to be at 65. So we're looking at 15 years away. Level income, I don't want any chance on this one. A minus or better. Next step. And I'm going to hit deep research here. So 50 years old, 200,000. And if I wait till 65, this company Talcott is number one at 39,724 a year, followed by American Equity, followed by Nationwide, Global. So you'll see there's a lot of carriers. And when you look at these, so I like to do a comparison between these three, the top three or whatever. Um, and if I hit download report, it'll give me a side-by-side comparison. Now, the reason why I like this is it shows the client choice. Now, one might say Talcott should be the winner because it's going to give me the most income. That's how most people look at these things. Okay, here's a side-by-side comparison of all three. Okay, you'll see income at 65, Talcott wins by $2,000 or $1,800, something like that. Now, you'll see here, well, Phil, what if you wanted to start your retirement earlier? Well, it looks like Nationwide would be the winner all the way up to 63. 67, American Equity wins. But here's the interesting thing is just looking at a spreadsheet of that calculator doesn't show the extra benefit here called the enhanced benefit. Now, what is the enhanced benefit? So if I have cash value left in my policy and I have a long-term care claim, so I can't perform 2 out of 6 activities of daily living, then they would double my guaranteed income until my cash value is completely liquidated at this higher number. So Nationwide doesn't have that in their product. These two do. So if I wanted to retire later at 80 at 67, then actually American Equity would win by $2,000. And I would assume that if I continue to go down, that stays the case. So the longer this plays out, American Equity is the clear winner by a long shot. Okay? So you'll see here that depending on when the client feels they want to retire, what I'm doing is I'm giving them a snapshot of all three. Now they make the decision, and what does that do for you as a agent? Removes liability. You're giving them choice and they're picking. Now these are three great carriers, all A-rated or better. The fact of the matter is it really just depends on when the client retires. So they said, Phil, you pick it. I'd say, when do you want to retire? Well, I don't know. Then I would say, in my opinion, it would be a toss-up between, Talcott and American Equity because I don't like the fact Nationwide doesn't have this extra enhanced benefit. So I've narrowed it down to two. Now it depends on if you plan on retiring between 64 and 66, or if you plan on going one extra year, American Equity would make the most sense. But you kind of drive the conversation based on questions. And when you ask questions to the customer, you're leading them down a path to get them to make the decision. Every customer wants to buy, they don't want to be sold. So that's what we have to do is we have to give them options, but let them make the final decision. So when we think about all this, again, this is that third part of it, the income base. We don't care about the cash value because if I actually took, let's say, the American Equity and I illustrated this by itself, you'll actually see in the contract value, this is the 0% column, right? The cash value diminishes by age 68, 69, but I'm getting guaranteed income and it's continuing to go. Okay. Now, if I pulled that up on it might actually be non-guaranteed right here. So you'll see non-guaranteed, so there's returns. It only lasts to 73, 74. But once again, the income still goes and it's guaranteed. So we're not trying to find the best possible accumulation on this. We're trying to find the best possible benefit base, or like I said in the beginning, the Mickey bucks for something like this. That way you have a higher net return, so to speak. So two different things to look for: accumulation, cash value. Accumulation is that's what it's meant for. It's in the name. But if someone is closer 50 or up and they're getting closer to that retirement phase, then you want to look more at the benefit-based type products or the income-based products. Once again, there's other products that have a higher concentration on annuity with long-term care versus income. And so if your client has a different need, we can always discuss that too. Any questions on this? My watch is telling me what I should say. So I'm going to ask one of our newer attendees, Lydia, did this make sense? Thumbs up. You ready to go sell an annuity? All right, else. Oh yeah, now you have to leave, uh-huh. As soon as I call you out, you're like, no, I gotta go. Have a good one. Tia, does this make sense?
It does. It does. I do want you to explain the spread one more time on the accumulation.
Yep. Yep.
Yeah.
So let's say, for example's sake, you have a 10% return. Okay. The first
Yes.
three goes to them and you get everything above.
Okay.
Okay. So it's a spread. They're going to take the first rights to the product because they're giving you a higher participation. Most companies are giving participation rates around like 55% ish. So 80% is pretty high. So they have to protect themselves as well.
Got it. Got it. Got it. So, okay. Okay.
Yep.
Does
So
that
yeah,
change
yes,
during
they
the
can change
contract
that.
or? Ah,
Yep.
okay.
Yep. So the carrier has every right to change their crediting rates and things like that. That's why I'll stay away from certain carriers on the accumulation side because of historical credit rate drops. Uh, I won't mention, F&G's name, but, I'll sell their SIA, Safety Income Advantage product. So it's a guaranteed income product. So F&G has a pretty good one from that standpoint. But, there's certain carriers that have accrediting they try and get more new business, so the
Mhm.
in-force blocks can pay the price. So I haven't seen that from carriers we already showed here, and that's why I like this software because it has a historical look back.
Okay.
So
Okay.
that historical look back had a 10, 15, and 20 year, or 25-year look back because again, I can turn that off, the historical look back, then all of a sudden you'll see a bunch of the um, volatility controlled indexes that you've never heard of that'll give you these awesome returns. But again, it's just on paper. It's not actual back testing and things like that. Like the volatility controlled indexes are probably about 6 years old, give or take, maybe seven. But the idea of the volatility controlled indexes is they'll say to you, "Hey, here's this company, say Merrill Lynch. Merrill Lynch created this index just for our company." And you know Merrill Lynch, they're a great company. Well, if
Mhm.
this was in force and active 25 years ago, it goes like this. But then since it's
Mhm.
been active, it went like that. So, like a lot of times that people do these volatility controlled indexes to make their products look prettier. And in return, they're just getting angry clients, plain and simple.
Got it.
Yeah.
Got it.
So that's why I say stick with the S&P. Carriers have NASDAQ. The NASDAQ's a great option too. The NASDAQ's a little bit more volatile than the S&P, but in a good way, because remember, if there's no fees, plus you have a higher potential return, you know, I'd say it's worth it. So those are the two that you really see all the time. I haven't really seen the Russell in this, but it's just another S&P 500, if you will. Uh, but those are the ones to stick with. If you even want, some people will put in some into the fixed account. So if the market takes a tanker, you still get some credit per year. So a client sees interest being credited. So that's always a nice thing. But it just really depends on your risk tolerance, your premium tolerance, risk tolerance, and duration for the funding options too. So all that plays into effect when you're talking about what's best for the client.
Got it.
What about you, Chris? Any questions? You look high concentration, or you're not listening. Either or. Well, if there's no other questions, I'll cut for the day. So um unless oh Chris, you did go off mute. Were you listening?
Yeah, it's listening the whole time.
All right. Any questions? Does this make sense?
Actually, I think I've watched this presentation now like probably 4 times, and now I'm beginning to understand how things are working. Um, so just trying to learn how to explain to people
Mhm.
how, why you want to go with an annuity instead of like a CD or anything like that. You know, and which annuities go with. So,
Well,
and what is important.
that's a great question. So, like, if I went back to the marketplace and just looked at a fixed index annuity, and let's say, for example's sake, we'll use we'll use American Equity. So the Asset Shield is their accumulation product. Okay. So if I wanted to illustrate this, and let's say I go to the allocations. So if I was a very conservative person, right, a CD is a guaranteed for 5, 7, 10 years, whatever, interest rate. If you want to see what we offer for MIGAs, which again is a CD from an insurance company, you go to the Three Mark portal and click on annuities, and what it'll have is all the MIGA rates. So you'll see a 10-year right now is 5.5%. So that's fixed. Okay. So if I strip away all the fees, okay, strip away the historical data, whatever. So, and I'm just using this for example's sake. I don't like them from an accumulation standpoint, but you have the S&P 500. Say the cap was like 8% or 11%, whatever, they put on there. You also have the fixed account. So current fixed rate 1.9%. So if you did a 50-50 between the two, you can get some guaranteed and some accumulation versus just putting it into a CD. Okay, this is a terrible example because the rate of returns look awful, but there are other carriers that have higher fixed accounts. So when you're matching a CD versus a fixed index annuity, you want to look at, for example, sake, the fixed account that they're providing. And the idea when you think about the economics, right? This is, I guess, one of the benefits of studying for the 65. A customer, when they put it into a fixed product, what they're losing is a potential loss to inflation or rising costs in general. So, if I could show you a way to cover half of your investment in something fixed so you have growth no matter what, and the other has some variability but no loss with a higher upside, would you be interested? And so now you could take them off the idea of a CD or a MIGA and talk about, say, a diversified accumulation annuity, part of it in the fixed, part of it in the accumulation side. Or worst case scenario, you just match rates. And if they want to go with something on the fixed side, we have options for the fixed side too. And they're all here in plain sight for you to read. So you should never lose to a CD. Does that help? Okay. Yeah. So again, there's a lot of different ways people can illustrate these things. Obviously, that return was garbage, but I can look up things with different, setups, bonuses, withdrawals, riders, more filters, so stuff like that, fees, pars, caps, spreads. So, depending on what you guys need, again, using that quote site, I can run it for you. If I'm not available, there's also Bo from 3Mark who can help out too. You just say, hey, I got this client. They're X age, they have this much, they're looking for accumulation, and then he can help run them too. So you got a team behind you to make sure you're taken care of one way or another.
So how
So
do we
on
tell?
the Valor FS site,
Yeah,
uh,
quotes, the quotes one.
yeah, I tried to find that and I couldn't find that
Well,
page.
yeah, I'll put it in the
Or is it
chat.
not up and running yet?
It's up and running. You probably didn't do the HTTPS colon slash slash. So if you click on the link in the chat, it should be there. Um, so it's a live link.
So how do we know which product, if we're looking through 3Mark, how do
Mhm.
we know which product is a fixed product and which product is a accumulation product? Or what am I saying it right? An income
Accu-
versus accumulation
Income
product.
versus accumulation. So
Mm-hmm.
under their tab with Luma, okay, if you click on
Mm-hmm.
Luma, this is their version. They can do income right here, create new income quote.
Mm-hmm.
These would be your income products. Now, if you do research
Okay.
and compare, this would be, let's say, Connecticut, 60, $100,000, and oh, it took out the age. I'll make him 50. Okay, so now what I can do is I can take out certain things. So if I wanted to get rid of, let's say, where is it? Nope, that's not it. Between, so carriers, that's okay. Product name, product type. Fixed index annuities, apply filter. So I'll get rid of the SPIAs. So when you see asset
Mm-hmm.
shield, that is an accumulation product. You're accumulating assets. Income
Okay.
shield,
Hmm.
income shield, income. Okay. So some of these
Got it.
will say it, some won't. That's why if you want to lean on the expertise, either myself or Bo,
Hmm.
we can help you get allocated or appropriated in the beginning, and then you'll start to catch on. Now, when you're ready to submit business, you can actually do it through the Luma site. So start application, product type, fixed index, American equity, and I can hit apply, and it will actually have the drop ticket for you to submit the business on the site.
Got it. Okay.
Okay. Now, the other thing, just a FYI, if you do annuities, you have to do the training first. So on
Yeah.
the portal, under resources and quotes, annuity training guide, it has all of the resources where to go. Already appointed, not appointed yet, doesn't matter. You can get it done. But before you
Okay.
submit the business, you have to you have to do the training. Okay?
Got it.
And they should all be here. But yeah, that's pretty much it. Any last questions, comments? Chris, did the link work for you to get the quotes?
Yeah, it did. Thank you.
All right. Well, I'll cut here. If you guys have any other questions, text, call, email, this will be up on the YouTube channel in case you want to look at it again. But as always, appreciate it. We should be back to a normal cadence next week. So Wednesday, 8 p.m., back to basics. Thursday, 4 p.m., regular training. Appreciate you guys. You have a great rest of your day, and we'll talk soon.
Thanks.
See you guys.